In the previous session, we have discussed about the simple payback period method, and as we have seen in that particular method, whenever we consider a simple payback period method, we simply focus upon two things: whatever is the investment and in how much duration, how much periods we are getting the investment back. So that is the only area of concern. And based upon this, we are comparing the projects, and the project which is giving the investment back in least period of time, we are selecting that particular project. So particularly this payback period method is used for comparison of various projects based upon the initial investment and the time during which that initial investment will be recovered back, that we are taking into account. But the major drawback for this simple payback period method is the time value of money. It is not taken into account. And as we are knowing, the time value of money is having a great importance as far as any financial calculations are concerned. So because of this limitation of simple payback period method, that the time value of money is not taken into account, so there is a modification for this payback period method, and this modification is by taking into account the time value of money. So this particular modified method, we call it as discounted payback period method. Now, this discounted payback period method, in this particular case, the cash flows, whatever are given, they are converted into their present values by applying suitable discounting factor. And this discounting factor will be based upon the cost of capital or rate of interest which will be given. And then we will be trying to add the present value of all these, or we will be taking into account the present value of all these cash flows, and then we will try to find out the payback period. So this is a one step ahead than simple payback period method. In simple payback period, the time value of money is not considered, whereas when we are going for discounted payback period method, we take into account the time value of money by calculating the present values of whatever cash flows they have been given with respect to the period at which that cash flow is occurring, and the discount rate or the cost of capital which is given. So let us go for a problem and try to understand the methodology. So let us say this is, you can note down this particular problem for a certain company. This is the available data: years 0 to 7 and cash flow in rupees. At 0, the cash flow is minus 10,000, means this is the investment, initial investment, and 3,000, 3,000, 4,000, 4,000, 5,000, 2,000, 3,000. These are the various cash flows, net cash flows, which are generated at the end of year 1, 2, 3, 4, 5, 6, 7. The cost of capital is given as 10%. So for this particular data, we have to check what is the payback period using discounted payback period method. If we, let us say, don't consider the discounted payback period method, then we can easily understand that 10,000, which is the initial investment, this will be getting repaid back in 3 years period of time. 3,000, 3,000, 4,000, 10,000 recovered back. So 10,000 which is invested today, within a period of 3 years, in the amount of 3,000 for first year, 3,000 for second year, and 4,000 for third year, all 10,000, this money which is invested has got recovered. So as far as the simple payback period method is concerned, our payback period will be 3 years duration. Now, since the cost of capital is given as 10%, we will be trying to apply the discounted payback period method and then check how much is the payback period and how much is the difference between the payback period what we get by simple payback and the payback period which we get by the discounted payback period method. So you can note down this year and cash flows in rupees for all the 0 to 7, that is 8 years period of time. Initial investment 10,000 and 1 to 7, these are the various cash flows at different years. Okay, now in this particular case, whenever you are going to solve the problem using discounted payback period method, you should go for preparing the table, and the columns of your table should be in this particular format: year or period which is given, then the cash flow, discounting factor, present value, and cumulative net cash flow after discounting. So please, you can make the tabular format, and this will be the headings. Total there are 5 columns: year, cash flow in rupees, then third column is discounting factor, and this particular discounting factor is how much? It is 1 divided by 1.1. Why this is 1 divided by 1.1? Discounting factor means it is 1 divided by 1 plus R. R is how much? It is 10%. So in that formula we will be putting the value in decimal. So it is 1 plus 0.1. So 1 plus 0.1 is 1.1. So the discounting factor, it is 1 divided by 1.1. So you can prepare the table and just mention this. Discounting factor is given as 1 divided by, inside bracket, 1 plus small r. So in this particular case, this is equal to 1 divided by, inside bracket, 1 plus 0.1. That is equal to 1 divided by 1.1. So this is our discounted factor. Discounting factor. So once you have completed the headings of the column, just mention all the years and their respective cash flows. So 0, 1, 2, 3, 4, 5, 6, 7 as given in the problem. So first two columns, they will be as it is, as given in the problem. So simply mention the first two columns as it is, the year and corresponding cash flow. Then discounting factor, always the discounting factor, it will be 1 at the beginning, and then everywhere this will be multiplied by 1 divided by 1.1. So whatever value you have, initially it is 1, then 1 divided by 1.1, then 0.909 divided by 1.1, 0.826 divided by 1.1, and 0.683 divided by 1.1. So likewise, we have to go on calculating. Now, why only up to 4 they have been calculated? We'll come to know. So let us say first two columns we have written as it is. By default, the first value should be taken as 1 because this is year 0. So ideally it is 1 divided by 1.1 bracket raised to 0. So anything raised to 0 is 1. So this discounting factor becomes equal to 1. Now this discounting factor and the cash flow, we should take the multiplication of these two. When we want to calculate the present value, it is nothing but cash flow multiplied by the discounting factor. So minus 10,000 multiplied by 1. So we get the value of this present value is equal to minus 10,000. And when we go for cumulative net cash flow after discounting, this is the first period only we have considered. So this becomes minus 10,000 as it is. So I hope you have understood the row number 1. In row number 1, 0 and minus 10,000, they were as it is given in the problem. Discounting factor is 1 because it is 1 divided by 1.1 bracket raised to 0. Okay, so that is equal to 1. Now the cash flow multiplied by discounting factor will be the present value. So minus 10,000 into 1 becomes minus 10,000. And since this is the first present value, cumulative net cash flow will be equal to the same value, that is minus 10,000. Now let us go to the second row. In row number 2, this 3000 which is given as it is, how this 0.909 has come? Either we can have 1 divided by 1.1 bracket raised to 1 because it is first year, or this 1 divided by 1.1. So every previous value in the discounting factor column should be multiplied with 1 divided by 1.1. So that will give you the next value. So 1 into 1 by 1.1, that is 0.909. Now again, cash flow multiplied by discounting factor, these two should be multiplied. So this will become 2727. 3000 multiplied by 0.907 will be giving you 2727. Now once you have this present value, this value is positive, and cumulative net cash flow for the previous, it is minus 10,000. So minus 10,000 plus 2727. This will give the cumulative net cash flow as minus 7,273. Is there any doubt in this? If you have, you can ask. Otherwise, the process will be same further. This particular process is to be continued for next period of time till you get converted from minus to plus. So now you can see, if you go for period number 2, 3000 given in the problem, 0.909 multiplied by 1 divided by 1.1, that is 0.826. 0.826 multiplied by 3000, 2478. This 2478 minus 7273. So cumulative will be minus 4795. The previous value for cumulative net cash flow minus 7273 plus the present value for period number 2, that is 2478. The cumulative net cash flow will be minus 4795. Then going to the next period, period number 3. Again 4000 as it is given, 0.826 divided by 1.1, so 0.751. 0.751 multiplied by 4000, 3004, and this 3004 plus this previous value, that is minus 4795. So this will give us minus 1791. Minus 1791. Then moving to the next period number 4. 4000 as it is given. 0.751 divided by 1.1, 0.683. This 0.683 discounting factor multiplied by the cash flow 4000 will give us the present value as 2732. And this 2732 added with minus 1791 will give us the cumulative net cash flow as 941. So now if we observe this cumulative net cash flow column, then we observe that after period number 4 or during period 3 and 4, the cumulative net cash flow, it has got changed from negative to positive. So in this way, we will come to know that the payback period is greater than 3 years and less than 4 years. Why it is not between 2 to 3? Because for 1, 2, 3 everywhere it is negative net cash flow, cumulative net cash flow. Whenever it changes the sign from negative to positive, during that period, the payback period will be decided or the payback period can be marked. So means the answer will be payback period is greater than 3 and less than 4. And because of this, once we get that the sign has changed from negative to positive, now there is no need to calculate the discount rate and present value for future cash flows for year 5, 6, 7. Because we have got the payback period between year 3 to 4. That will be the end of this particular problem. So in simple payback period method, the payback period was only year 3 or 3 years. But when we go for discounted payback period method, we come to know that the investment is not actually getting repaid back in 3 years duration, but it is getting back in a period more than 3 years and less than 4 years. So I hope you have understood this particular discounted payback period method, which is one step ahead than the normal simple payback period method. Then the last method of this investment decisions is accounting rate of return, which is in short called as capital ARR, or it is also called as average rate of return. Again, the abbreviation remains same, accounting rate of return or average rate of return on investment. So this particular accounting rate of return or average rate of return on investment is a measure of profitability which relates income to the investment, both measured in accounting firms. As the income and investment can be measured in various ways, there can be a large number of measures for accounting the rate of return. The various commonly employed measures are, so there are various types of formulae which are available for calculation of accounting rate of return. So these are some of the formulas. Capital A, that is equal to, or the formula A, the ARR is equal to average income after tax divided by initial investment. Formula B, ARR is equal to average income after tax divided by average investment. Formula number C, ARR is equal to average income after tax but before interest divided by initial investment. Formula D says ARR is equal to average income after tax but before interest divided by average investment. So normally if you look at the formulae, the denominators are changing. Either we can divide by initial investment or we can divide by average investment. But always it is income to investment ratio, that is full and final. Then formula E says it is average income before interest and taxes divided by initial investment. F is average income before interest and taxes divided by average investment. And formula G, it is ARR is equal to total income after tax but before depreciation minus initial investment divided by initial investment divided by 2 multiplied by number of years. So this is slightly a complicated formula. Now the decision rule, how to decide whether to select the project or whether to go for selection of the or rejection of the project is higher the accounting rate of return, better will be the project. So the accounting rate of return value should be maximum. So if there are multiple projects, then for each project you can go for a calculation of the accounting rate of return, and the project which is having the highest value of ARR, that will be the best project among the projects which are offered. Usually there is a pre-specified cutoff rate of return as 15 to 30%. Projects having ARR greater than or equal to this pre-specified rate are accepted. So if there is a single project and you need to determine whether to accept the project or not, then normally the rate of return, cutoff rate of return is specified. It is 15 to 30%. If the average rate of return or accounting rate of return for the given project is more than this cutoff rate of return which is mentioned for that project, then the project can be accepted. Just will go for one video. Please check whether the video is properly visible and also
Accounting
audible.
rate of return is a way of measuring a return on investment. It's called accounting rate of return because it uses net income and compares the net income to the
Is it
cost of an
audible?
investment. It's commonly used in
Yes,
capital
sir.
budgeting decisions, and if the accounting rate of return as expected is higher than the required rate of return for the company, they would go ahead with the project. Now let's look a little closer at how it actually works. Here's an example. Say a company expects an accounting rate of return of 5% on an investment. It means that they're going to earn 5 cents for every dollar they initially invested, but that 5 cents is earned per year over the life of the asset. So if the accounting rate of return is greater than or equal to the required rate of return, meaning however much return the company wants to make, then they should move ahead with the project. If the accounting rate of return is less than what they want to earn or require to earn, then they should not move ahead with the project. That's the simple concept behind accounting rate of return. The higher it is, the more profitable the investment is, but it may also mean that the investment is riskier. So it's not exactly clear that the highest ARR is the best, but it does mean that it's a very high returning project. Let's look at the formula. The formula is equal to the average annual profit divided by the average investment. Let's look at an example now. Imagine a company that was considering making an investment of $100,000 to buy some machinery. The inflow from the machinery would be $20,000 in the first 2 years, $10,000 in years 3 and 4, and $30,000 in year 5. The machinery could be sold at the end for a salvage value of $25,000. Let's calculate the accounting rate of return. The first step is to calculate the average annual profit. Remember, net profit or net income is not the same thing as revenue. We have to take the cash inflows and deduct the depreciation expense, which is the amortized cost over the life of this project. So the total profit from the project is $15,000 divided by 5 years is $3,000 per year of profit. Next step is to calculate the average investment value. The average investment value starts with the initial investment, which was $100,000, and then adds to it the ending value, which is the salvage value, and divides by 2. That means over the life of this investment, its average value is $62,500. Once we have that, we can calculate the accounting rate of return by taking the average profit and dividing it by the average value of the investment. So the ARR is 4.8%. Let's compare accounting rate of return to internal rate of return. Internal rate of return is used in economic analysis and financial modeling. It's based on cash flows, not accounting metrics. So it takes an initial investment, as you can see in the example below, of 100, that's an outflow. It then takes all the inflows of cash in each period and calculates the compounding rate of return from that investment. To learn more about internal rate of return, check out many of our YouTube videos and our business valuation modeling course.
Hey, do you run a business? Well, here's the thing, only 5 out of
Hi, welcome to the session of Financial Management's Capital Budgeting. In this session, we will be learning about capital budgeting concepts such as net present value, internal rate of return, profitability index, and payback period. The aim
just
of
try
this
to
video
revise
is to
this all
teach you capital
through this
budgeting
video.
concepts in less than half an hour, right from the start till the end, without skipping any key concepts, and also to show you a couple of mathematical examples. I believe by the end of this video, whatever the doubts you have would all be cleared. So if you are a project manager or an MBA student or an entrepreneur, stay tuned till the end of this video, and I promise to do justice for the time being spent on this learning. So what exactly is capital budgeting? In simple terms, it is finding out whether or not to invest money in a project. So let's say you're given 2 projects to choose from and you can invest only in one project. Then how do you make informed decisions? This is what exactly we're going to learn in this video. Capital budgeting techniques uses the following criteria to make informed decisions. 1, net present value, which is also called as NPV, and 2, it is internal rate of return, abbreviated as IRR, and then we have profitability index, sometimes it is written as PI, and we have payback period. So what is net present value? At a high level, it tells us about what is the value of the return on investments. And what is IRR? At a high level, it tells us the percentage of return on the investment. So NPV tells us the value of return, the IRR tells us the percentage of return. And profitability index is nothing but determining for every dollar that we spend on the project, how.
So this profitability index is nothing but the benefit cost ratio, what we are considering, BCR.
Much are we getting back? And finally, we have payback period. It tells us the break-even point to recover our investments. It tells us by what time or what period we can recover the investments made into the projects. Okay, capital budgeting techniques fall under the umbrella of financial management. So it is important to know where in financial management these capital budgeting techniques fall into. Let me take you through an overview of financial management just so that you can get some idea as to which branch of financial management deals with capital budgeting. Now, if you are trying to make a note of this, don't worry, I'll be sharing you the presentation link in the description and you can download that and you can keep it with you for your reference. It is a 40 slides presentation. You see, I'm trying to take care of your learning here. So please stay with me and I believe you will take a lot of learning from this video if you're trying to learn about capital budgeting techniques. All right, let's get back to the topic. So the financial management is primarily divided into two functions. One, corporate finance. Two, accounting and control. And these are further divided into sub-functions. Each function is a big subject in itself and would take hours, if not days, to learn about them. And our focus would be on capital budgeting. So I have highlighted them in yellow here. It falls under the corporate finance function, under investment decisions and under projects. So in general, any organization, before undertaking any project, they would conduct two types of studies. One is technical feasibility study and another one is financial viability. If a project is not technically feasible, then there is no point in going ahead with the project. So the project ends there before even getting started. And let's say the project is technically feasible, then the organization would conduct the financial viability to know whether it is worth to invest the money in the project or in some other asset or some other project. So if you plan to become a financial management guru, learn all these functions. Okay, so let's move on to the next slide. Before we get started with capital budgeting techniques, there are few concepts that you need to be aware of, and that really helps you to grasp this subject with a lot of ease. And there is a term called opportunity cost.
If you can't find a way to make money while you sleep, you will have to work till you die.
And for those who do not know what is opportunity cost is something that you would give up in order to get something else. For example, if I'm not making this video, then I would be spending this time probably reading a book or something else. And the opportunity cost for me for making this video is the time lost reading that book or doing something else. But then why would people let go the opportunity cost? Because people think rationally and they would weigh the pros and cons of each activity before they do and choose the best alternative available at the point in time. Okay, so on the screen you have two options. You can either invest the money in your bank or in a project. And if you invest the money in the bank, you get 8% returns. And if you invest your money into the project, you get 10% returns. So what is the opportunity cost of the money if invested in a bank? The answer is 10%, because you are losing 10% that you could have gotten from the project if invested there. Now, if I use the same example, what is the opportunity of the cost of money if invested in the project? And I believe you got it right. The answer is 8%, because you're losing 8% that you could have gotten from the bank if you have invested the money in the bank instead of a project. So we have two mutually exclusive events here. If you invest in bank, you lose the returns from the project. If you invest in project, you lose the returns from the bank. So in each case, you have the opportunity cost. Just keep this opportunity cost in mind. It will be coming in forthcoming slides. And this concept is really important to understand capital budgeting techniques. And there is another important concept that you need to learn for capital budgeting. That is nothing but discounted cash flow and non-discounted cash flow. Discounted cash flow is a financial word for opportunity cost. So in a way, discounted cash flow is nothing but the opportunity cost. Sometimes the word discounted cash flow is written as cost of capital or opportunity cost of capital. These all terms mean the same. Again, for a quick reference, let's look at this question. Let's say if an organization earns 10% per annum on its capital by putting the money in the bank instead of investing in a project. Now, what is the opportunity cost of the capital? You're right, it is 10%, because that is what you are losing for choosing to invest in the project. And now, what is non-discounted cash flow? It is simple. It means that we are not considering any opportunity cost and we don't have to think about any discounted cash flow. Now, here comes a consideration to keep in mind. In general practice, discounted cash flow is taken into consideration while calculating the net present value, internal rate of return, and profitability index. And for payback period, we do not consider the discounted cash flow. So if you're still watching, then we are making a good progress with the subject. We need to learn one more concept called time value of money. I'll realize how easy they are going to be by knowing these simple concepts. So stay tuned with me, please. And I believe it is important concept to learn, not just because of the financial management, but in general too. Let's take a look at it. So to give you an example, the money that is sitting in your wallet right now is worth more today than the same money sitting in your wallet tomorrow. Can you tell why? Because the value of money depreciates over time. If you're not putting that money into use, it is just depreciating its value. So you can ask, why is it depreciating in value? It is the same $100 bill that you're carrying in your pockets. The reason is,
in the last 2 years, I went from being in the job and doing things that I'm
time. Yes, time. As many of us think, it is not just about the money, but it is always about the time and money together. And this brings us to the fundamental concepts of time value of money. There are two fundamental concepts that we need to learn about time value of money, which is future value of money and present value of money. And let's go ahead and look into that. Let's understand the relationship between the future value of money and the present value of money. Luckily, we have a formula for it, and the formula is FV is equal to PV multiplied by 1 plus K whole power N. Here, FV means future value, PV means present value, K means discounted rate or the opportunity cost, and N means time. So let me tell you good news. If you observe carefully, this formula is nothing but a compound interest rate formula that we may have learned in our school days. Okay, so let me give you another good news. It is just one formula that you need to remember to do all the calculations of capital budgeting techniques and nothing more. All right, and if we need to calculate the present value, you just send 1 plus K to the power of N to the other side of the present value formula as future value divided by 1 plus K to the power of N. And let's do a few calculations using the formula, and then let us calculate the future value. On the screen, you see an example. If $100 is invested in a bank today, it would earn 8% per annum interest. Then what is the future value of that $100 after first year, fifth year, and 15th year? In this scenario, the 8% is our discount rate, which is nothing but the opportunity cost. And $100 is the present value. And we need to find out the future value of that $100 for the first year, fifth year, and 15th year. So the value of PV is $100, and the value of N is 1 for first year, and the value of N is 5 for fifth year, and 15 for 15th year. And the opportunity cost is 8%. That means K is 8%, which means 8 divided by 100, and that gives us the value of K as.
I remember when I started in 2009 and became an entrepreneur, I was completely blind to
As 0.08. And let's plug these numbers into the calculations. To simplify, I first calculated the value of 1 plus K, which is 1 plus 0.08, and that gives me 1.08. And for the first year, it is 100 multiplied by 1.08 to the power of 1, and that gives us $108. And if you do the calculations for the fifth year, it is 100 multiplied by 1.08 to the power of 5. And if you do the math, it comes up as $146.93. Okay. Similarly, if you do the math for 15th years, it is 100 multiplied by 1.08 to the power of 15, which gives us $317. Now let's go ahead and look into how to calculate the present value. Let us take the same example. The example on the screen states that if you're going to get $100 after first year, what is the present value of the $100 today? And if you're going to get $100 after fifth year, then what is the present value of that $100 today? Similarly, if you're going to get $100 after 15th year, what is the present value of that $100? Date. That means the $100 here is the future value. We have the time, that is n is equal to 1 for the first year, n is equal to 5 if we have to calculate for the fifth year, n is equal to 15 for 15th year. So the discounted rate is given as 8%, and we need to plug in these numbers into the formula and do the calculations. Now I have done the calculations on the screen here. These are the numbers that I got. You can pause the video and do it yourself and cross-verify if you're getting the same numbers. And so to summarize, K means 8%, which is 8 divided by 100. That gives us 0.08. If you add 1, it gives 1.08. Now for the first year, it is 100 divided by 1.08 to the power of 1. And that gives us the present value of $100 as $93. And if you do the calculations for the fifth year, it is 100 divided by 1.08 to the power of 5, and which gives us the number as $68. And similarly, if you do the calculation for 15th year, you're getting the value as $32. And with these,
so of course, you know you can make money on YouTube, but did you know you can make money on YouTube without ever showing your face?
we've completed the concepts part. Let's quickly recap what we've learned so far. We've understood what is opportunity cost, which is nothing but the discounted cash flow. We've learned about non-discounted cash flow as well, which is nothing but we're not taking into consideration any opportunity cost. We have understood what is time value of money and learned about the future value of money and present value of money, learned the formula that we need to use to calculate the future value and present value of money. So we're about to get into the meat of the subject, and it is going to be easy as we've already looked into basic concepts that we need to be aware of. So stay tuned until we finish these calculations. All right, let's now start with net present value. The key word here is net. Net present value means from the sum of all present values, you need to remove the cash outflows. If I have to give you an example, in your salary slip, your gross salary is the sum of all your income, and if you remove your taxes, your savings, etc. from that, you would be left with your net salary. Likewise, for net present value, you need to remove all the cash outflows from the sum of all present values. Let's do an example calculations and it'll be easy to know. Before we do the sum, just remember the criteria. If the net present value is greater than 0, then it is better to accept the project and we can work on the project. And if the net present value is negative, which is less than 0, then we should reject the project. We should not accept a project which has a net present value in negative. And if the net present value is exactly equal to 0, then you can accept the project given the project is giving you some other experience and some other tangible benefits. So higher the net present value, it is better for our return on investments and better for us. So let's do the math now for net present value. A sum of $400,000 is invested today in an IT project. It may give a series of cash inflows as described on the screen, which is $70,000 for year 1, $120,000 for year 2, $140,000 for year 3, and $140,000 for year 4, and $40,000 for year 5. And if the opportunity cost is 8%, should we accept the project or not? This is what we're going to find out. So in this question, $400,000 is the investment that we are making. That means we're spending the money out, which means this is a cash outflow. And the cash inflows are 70,000, 120,000, 140,000, 140,000, 40,000 for year 1, 2, 3, 4, 5 respectively. So first we need to calculate the present value of all these years. and then we need to sum these present values. And whatever the value we get, we need to remove the $400,000, which is a cash outflow, for us to get the net present value. Okay, we have the discount rate as 8%. Since we have to calculate the present values, let's use the present value formula. Okay, let's plug these numbers into the present value formula. For year one, the amount is 70,000. K means discount rate, which is 8%. And if you do the calculations, we get the present value for the first year as 64,814.8. And for year two, we have the amount as $120,000. And if you do the math, we get the present value for year two as 102,880.7. Likewise, if we do for year three, year four, year five, these are the values that we get. And as a part of the rule, we need to sum up all the present values. And if we do that, we get the value as 408,959.5. And for the net present value, as I said before, we need to remove the cash outflows. So if you remove $400,000 from 408,959.5, it leaves us with $8,959. This is a positive number. This is a positive net present value, which means we can accept the project. Now let's go ahead and do one more calculations on net present value with the same example, but this time instead of using the discount rate as 8%, let us make it 15% and see what's the outcome of the project. Okay, so you can pause the screen and do the calculations, but I have done it for you. If you plug in the numbers to the formula, the net present value comes up as negative $56,408, which means the project is not financially viable because we have a net present value as negative here. So the key point to note here is when we used the discount rate as 8%, we got the positive net present value. And when we used the discount rate as 15%, we got the negative net present value. So what does it mean? It means that net present value is very much dependent on the discounted cash flow. Okay. And if you get a question like, would the net present value change by the change in discount rate? The answer is yes. Okay. As the discount rate goes up, the net present value would come down. Both are inversely proportional. Now let's look at the internal rate of return, or simply called IRR. IRR is nothing but the percentage of return that you're going to get on your investment. So how do you calculate the IRR? If you remember from our net present value example, as the discount rate increases, the net present value decreases, right? So we need to figure out at what discount rate does the value of net present value become zero. And the rate at which the net present value becomes zero is the actual rate of return from the project. The criteria for the internal rate of return is if internal rate of return is greater than discount rate, then accept the project. And if the internal rate of return is less than the discount rate, then reject the project. And if the internal rate of return is equal to the discount rate, then you may accept the project considering other project benefits. Also, let's look at the other relationship between internal rate of return, discount rate, and net present value quickly. So whenever internal rate of return is greater than discount rate, your net present value is going to be always positive. And if the IRR is less than discount rate, then the net present value is going to be negative. And if the internal rate of return is equal to discount rate, then the net present value is going to be zero. Let's now look at the example for calculating internal rate of return. The cost of the project is $1,000 and has got a time horizon of 5 years. And the cash inflows are for year one, it is $200. For year two, $300. For year three, it is $300 again. For year four, it is $400. And for year five, it is $500. The opportunity cost is given as 12%. And we need to confirm if we can accept the project. Here, the future values of all the 5 years are given. We have the cash outflow as $1,000. We have the discount rate as 12%. Since the question is to calculate the internal rate of return, we first need to calculate the net present value. If it is greater than zero, then we need to increase the discount rate, let's say like 13% or 14% or 15%, and then we need to recalculate the net present value. And the moment your net present value becomes zero at whatever the discount rate it is, that discount rate is considered as internal rate of return. When we do the calculations, you will get to know more about it. Okay. I have automated this particular step in an Excel to save time on calculations. So here you see K value as 12. 12% means 12 divided by 100, which is 0.12. And 1 plus K means 1 plus 0.12, which is 1.12. Down below, you see the year 1, 2, 3, 4, 5, and the future values 200, 300, 300, 400, 500. And next to it, the value of 1 plus K to the power of N. And again, next to it, the formula of present value. The moment I change the value of K here in this row, it gets changed here, and the present value gets automatically computed. Down below here, I'm summing them up to get the sum of all present values. And here I'm removing the cash outflow from cash inflows to get net present value. Since our aim is to calculate the internal rate of return, we need to change the value of the discount rate to see at what discount rate the net present value becomes zero. And that rate is considered as internal rate of return. Let's see here. At 12%, we get the net present value as 169, which is higher than zero. So we need to increase the discount rate and we need to check what the net present value is going to be. So if I change the net present value from 12% to 13%, we get the net present value as $136, which is still high. Let's do one thing. Let's change it to 18% and see what the value is going to be. Okay. So if we change it to 18%, the value here becomes negative, but we need the net present value as zero, neither negative, neither positive. Okay. So let's try 17. No, at 17.5, we close. Let's try 17.7. Okay, we get the net present value as 0.25. So let's try 17.8. Okay, it becomes negative 2.38. So at a discount rate of 17.7, the net present value becomes 0.25, which is close to zero. So therefore, we need to consider this 17.7% as our internal rate of return. And now, since this internal rate of return is 17.7, which is greater than the discount rate of 12%, we can very well accept this project. So this is how you calculate the internal rate of return. Okay. Now let's look at the profitability index. So what is profitability index? It is knowing for every dollar we spend, how much are we getting back. It is easy to calculate. We just need to divide the cash inflows by cash outflows, and it gives us the profitability index number. Let's do the calculation here. Okay. In this example, we need to calculate the present value for the year 1, 2, 3, 4, and 5 and sum them up. And that gives us the value of all cash inflows. And here we have cash outflow. We just need to divide the cash inflows by cash outflows, and it gives us the profitability index. I have done the calculation here and got the cash inflow as 26,814.29. And we know the cash outflow is $25,000. So if we divide 26,814 by 25,000, we get 1.07. And since the profitability index is greater than 1, we can accept the project. And I did the same calculation here in Excel, so you can download the presentation and you can refer to the sheet. Okay. And now let's look at the last technique of the capital budgeting, which is payback period. As the name suggests, it is the break-even point at which we can recover our initial investment. Here are some of the criteria for payback period. A good project will not only have a good net present value or the internal rate of return, but it also will have an early payback period. Let's say you have two projects, and if all the values remain the same, such as the net present value, the internal rate of return, or profitability index, then your criteria is the early payback period. Having an early payback period means you can recover your money early, and you can invest that money into other projects. Okay, as I have mentioned earlier, for payback period we will not consider the discount rate. Okay, so let's look at the example. Is the same example we have looked into for profitability index. Let's now calculate the payback period for the same example. So what we need to do is we need to figure out when we can recover our investment. The initial investment is $25,000. In year one, we recovered $5,000, and in year two, we recovered $9,000. So in total, we recovered $14,000 till the end of year two, which is nothing but the sum of 5,000 plus 9,000 in cumulative numbers. And using the same cumulative addition, by the end of year three, we can recover $24,000 in total. And that leaves us with $1,000 more to recover. So by the end of year four, we can recover up to $34,000. Since we only are concerned with recovering $25,000, what we can do is we can break the $10,000 in the year four by month wise. So it will give us $833 per month. So going by this logic, we can recover our investment in about 3 years in 2 months time. So with this, we finished the calculations on capital budgeting techniques. So on the screen, there are a few tips to make a note of from your examination point of view. I think this is important. Related them here. This is in the presentation. I just wanted to put them all in one place for your convenience. It is in the PPT anyway. If you like to download the PPT, you can visit the link in the description section and then download it. So let's do a quick recap as to what we have learned in this video today. We've started with the definition of what is capital budgeting techniques. We looked into the financial management overview. We learned about opportunity cost, which is nothing but the discounted cash flow. We learned about time value of money, with which we can.
So let us stop over here, and I hope you have understood this various numeric models for project selection.